press.
Okay, good afternoon everybody, and welcome to SIPFA's webinar on service transformation by delivering differently. My name is Lisa Forster, and hopefully you can all hear me and you can all see me. If you look over on the right hand side of your screen, you will see a number of little links that you can click on. If you click on the attendees link, and you will see a picture of a hand. If you can hear me, can you please click on the hand? And we'll just make sure that any technical problems we can get sorted out before we start. Okay, it's looking good. It's looking as though nearly everybody can hear me. I'll just give a couple more seconds for people to be able to log on. If you're having problems in terms of hearing or currently seeing the slides, again on the right hand side there is a questions box. If you could write your questions in there, and then again we can pick them up throughout this webinar. What I'm going to do is just turn the webcam off now, so at least you know I'm a real person here doing this, but you should still be able to see the screen and hear me. Okay. It looks as though everybody is okay in terms of visuals and audio, so we will make a start. Okay, a little bit about me first of all. My name, as I've said, is Lisa Forster, and I'm a finance advisor and a consultant here at SIPFA. I've worked here for about 7 years, and prior to that I've been a local authority accountant working in a variety of different departments. Just a little bit about logistics, and I am conscious there are a couple of people that can't hear. So we're just trying to work that on at the moment. So a little bit about the logistics. As I say, if you have a question, can you please write your questions in the question box and we will pick them up. And as I say, I am aware that a couple of you have got audio problems. Okay, we're working on those at the moment. This webinar will be recorded as well, so you will be able to listen to it as you wish. Okay, again, you can talk in the questions box at the bottom. If I can answer the questions throughout the webinar, then I will do. However, if some of the questions are very technical or very specific, we will take those later and we'll do you a frequently asked questions list and put it on the website. So what are we going to do today? Well, first of all, we're going to talk about why we need to deliver differently. Why is it suddenly such a hot topic? Then how to choose which direction to go in terms of how do I choose which model to deliver differently by, and then the benefits and disbenefits of different models, and then what we need to set up and operate those, and last but not least, some critical success factors. So, starting from the beginning, why do we need to deliver differently? Well, it's really around the balance of things, as you can see on this slide. Local authorities are finding themselves in quite a precarious position at the moment. They're battling on a number of fronts in terms of having a very tough financial settlement matched with lots of pressure to support increasing numbers of vulnerable citizens during the economic downturn. Now let's look at the resources side of this equation. The essence of the government's funding regime, really since around 2011, has been to move away from a system that's been dominated by top-down grant funding to one that mixes that with locally raised resources such as business rates and new homes bonus. Now there's a real risk and reward design that's factored into this that means authorities have to have much more commercial and business orientated outlooks. On the other side of the equation, the more cost side, we're seeing demand on services growing. Now that's partly due to our changing demographics, so for example high birth rates and a growing ageing population. Those two parts of our society are the most intensive users of our most costly and essential services, such as education, health and social care. And of course, exacerbating that, we've also got the impact of the recession, and that's resulted in financial difficulties for many families. So we're seeing greater pressure on local authorities' social services, including housing and welfare. So it's a very challenging, but a very changing landscape. And if we compared local authorities now to 10 years ago, we would have seen very clearly delineated boundaries in terms of public, private and third sector. We've now got new partnerships which are combining all those different sectors in a way that we haven't seen on such a scale before. Lots of diverse, very new and often competing delivery models. And of course the new player on the block is devolution. That's next big thing, question mark, as you can see on the slide, and that's because we really don't know how that's going to play out. It'll take us a couple of years at least to see the benefits around that service. So finding your way to a balanced budget is going to be very tough, whichever area of the public sector you are in, and whether you are urban or rural, it doesn't matter. So the question is, which way to turn? Now we did a survey within CIPFA Networks and we said to local authorities, if you were to deliver differently tomorrow, what's stopping you? And you can see from this word cloud, there are a few things that really jump out at you. And if I just move on to the next slide, and I can show you here the top 5 from our survey. The first one was around understanding. And that's people saying, I don't understand what the different delivery options are. I might think we can have a trading company, but what does that mean? What's the legal implications? How does that affect our staff? How does it affect our culture? What does it do for stakeholders? And what's the legalities of it in terms of what can we actually do? The second one is a really important one, and it's around control. Very often people don't want to lose control. Now that could be staff members. It could also be an element of political sovereignty in there as well. And it doesn't matter how you're delivering, whether it's a shared service or a local authority is a commissioner rather than a supplier. The loss of control is very important to address. For example, if you are a commissioner, it means that the council will have a looser hold on service delivery itself, and that could suggest greater potential for supply chain failures that would impact services. So it's something that really needs careful consideration. The third one is around resistance to proposals, and that's often linked with the fear of the unknown. People may have a vested interest in maintaining the status quo because we're seeing a move to alternative service deliveries, particularly shared service, having a real rationalisation of staffing structures and processes. People feeling, I'm not sure what my job prospects are if we move to a shared service arrangement, therefore I'd rather keep with what we've got. Engagement, communication and clarity about why an alternative delivery model is the best thing to do is absolutely clear to address those resistance to any proposals you have. The fourth one is around poor data, and this is people saying to us, we would like to move to an alternative delivery arrangement, but we're not sure whether it will be more effective, and that's in terms of both cost and performance. And the reason they don't always know if it's going to be more effective is because they don't have that data of the current service to compare to what it would look like under a different delivery mechanism. The fifth point is around future-proofing. So people saying, we know we need to do something, and we've recently had an instance where local authorities are saying, if we don't do something with our services, we're not going to be able to protect our non-statutory services. So we need to make these efficiencies over, say, back office services. So they're the 5 top areas that people were concerned about from our survey. And if I just go back to this word cloud here, you can see there's a lot more in there. People are saying, well, what works? What's everybody else doing? What direction do I go in? Is there appetite? What's the scope? What's the risk? So there's a whole host of things that people have a real nervousness around in terms of moving to alternative delivery. But hopefully today we can go through some of those issues. It is very high level, but we'll try and point out some of the main points. So how do we deal with the issues and where do we start? I'm just going to do a quick poll here as well. Now, the first poll I've got is, are you directly involved in setting up alternative delivery vehicles? Now, I've launched that poll and you can see you have two responses, either yes or no. And if you could click on which is relevant to you, just so we know our audience, but it just gives us an idea of what people are doing. And then we're going to follow that up with another poll a little bit later on. So I'll just give you a few seconds to continue to click on that. At the moment, it's looking about 2/3 of you are saying no, you are not involved, and 1/3 of you are saying yes. We've got 85% of people voted. So I'll just hang on for a few more seconds there. Okay, we'll stop it there. Carry on. If you haven't voted, please just continue to click in the boxes. But the percentages are staying the same. So about 2/3 of you are not directly involved. And that's pretty common. We're seeing throughout SIPFA that a number of local authorities are saying, we know we really need to do something, but we're not quite sure what. And other people are saying, we are doing something in our local authority, but I'm not directly involved and I'd like to know more. So hopefully we can give you a flavour of what those issues are. Okay. So when we are looking at delivering differently, there is a certain order that we need to go through. And it's very important, as you can see in those big red words at the bottom of this screen, form must follow function. We need to be very clear about that. It's not a case of deciding, well, we need a training company, but we're not quite sure what we're going to run through it. We're not quite sure what it's going to do. It's absolutely essential that you look at your objectives first and why you want to do this and whether it is the right thing to do. Because actually delivering differently might not be the correct route to go down in everybody's case and for every service. So look at your objectives and your outcomes. Now, local government has often taken quite a paternalistic view of service provision in terms of them deciding what citizens want, how they want it delivered, the volume of delivery, and also the delivery mechanism. This is a chance to really take a step back and look at your strategy and your vision. Be absolutely clear about your objectives. So what is the service trying to achieve? What are the problems that you need to resolve in order to deliver a very compelling argument and a very compelling future for that service? Are you absolutely clear about the reasons and the drivers for considering other delivery arrangements? And that point is essential if you want to bring your stakeholders along with you. They need to be very clear as well why this rationale is sound. You also need to look at how robust your current operation is in terms of both skills, performance and finance, and ask yourself the question, would delivering this differently improve or worsen the situation? Once you've done that, you need to look at the model. So you're looking at whether you're going to do this alone, are you going to do some sort of partnership? And again, your objectives will lead you to that answer. And then are you looking to be very commercial and generate income that you wouldn't have done under the local authority? Are you going to be charitable? Are you going to be a separate legal entity? Now this next slide really puts that into more context. There are a number of questions in terms of the model that you, or the optimum operating model that you need to assess. Control is one of the key ones, and that's what degree of control do you wish to retain or relinquish. Now, if your members, for example, say, no, we absolutely want to retain sole control of that service, we don't want any partnerships, then you're looking at doing things that are on the left-hand side of this circle. So you might look at what you're doing in-house, but just improve it by remodeling, looking at your service level agreements. You might actually even look at decommissioning. Another thing that you might do would be to set up what's known as a TECL company. Now, there are long and complicated discussions and challenges around TECL, but basically it's a company that can be wholly or jointly owned by local authorities that provides services back to the local authority. You could also be a little bit more innovative, and you could say, well, actually, we do things in-house that could be made commercial. We can generate income from them. So we want to set up a wholly owned trading company. And that, again, guarantees that the local authority has that control. And you might want to look at other areas of income generation that you haven't done at the moment. If, however, control isn't so essential to you, then you can look at other areas where you have less control, such as outsourcing, or perhaps some collaborative arrangement, shared service, some local authority delegation, or even a jointly owned company. Now, control isn't the only issue that you need to use to assess your model by. You might also want to look at complexity. How complex or unique is the service? And what specialist skills, if any, do you need? So if it's a very unique service, you might say, actually, there's only us that can deliver it. Or it could be, we don't have the skills to deliver it. If it's a service that is, let's say, transaction processing, it's not very complex, there's a lot of commonality there, then that actually might be one that you could share with other local authorities by either a joint committee or a jointly owned company, because it's easy to share. You might also want to look at collaborators. So how many partners do you wish to be involved in the delivery, and what sort of specialist skills do you want them to have? And then, of course, you also need to look at the resources in terms of time, money, or skills. So once you've addressed your strategy, you've decided what sort of model you want, i.e., I want to do a shared service, you then need to look at the vehicle. And this is really around the legal aspects, and that includes the transfer of assets and liabilities and the financial impact of that. Now, we're going to look at that in more detail a little bit later on in this presentation, so we'll just move forward for the moment. So let's have a look in more detail about what the different models and vehicles mean. I'm just going to pause and talk about the language before we go into the definitions. On the left-hand side of the screen, we have delivery models. So when somebody says to you, I've got a shared service or I've got a local authority company, that's the model. It's not the vehicle. The vehicles are shown on the right-hand side. So this is the detail, it's the legal form. So if, for example, it's a company limited by shares or guarantee. The vehicle is very important because that states the boundaries for what you can and cannot do in terms of trading, any profits, any taxable reliefs, any staffing transfers, etc. So we're going to have a look next at what delivery vehicles apply to different delivery models, because not every vehicle is applicable. But before we do that, we're just going to do another quick poll, and that is, are you aware of the different vehicles that apply to different models? I'm just going to launch that before we go into the next screen. So if you can just click yes or no, I'll just give you a few seconds to do that, and it just gives us an idea of what people are really looking for out there, and then hopefully we can provide more information for you on this. Now at the moment we've got about 80%, we've got 85% of you voted, and it's a resounding no in terms of you're not aware of the link between the models and the delivery vehicles. I'll just give it another couple of seconds. So we're over 90%. And it's still a resounding no in terms of 72% of you at the moment are not aware of the different vehicles that link to the delivery models. So this next slide will hopefully answer all your questions. This shows you the models across the top. Now we've picked the main ones and it shows you the legal vehicles down the side. Now the very last column is local authority delegation. We're just going to leave that one for the moment and look at the others. So for example, if as a local authority you said, we want to set up a charity, what can we do? Well, you can set up a charity as a company limited by shares or guarantee, as an independent and provident society, community benefit society, or a co-op, or a charitable independent organisation, which is a new legal vehicle. What you cannot do is set up a charity as a co-op or a limited liability partnership. And I apologise, I did just say a co-op as a yes. If you want to set up a staff mutual, you can actually set it up as any of these legal vehicles, with the exception of the Joint Committee and Lead Authority at the end. What we often see, or the most common ones, are local authority companies. So what can you do there? If you set up a local authority company, you can do that as a company limited by shares or guarantee, as a community benefit society, or as a cooperative. You cannot have a company that's a limited liability partnership or a charitable independent organisation. Now the last column is around local authority delegation. So this is really keeping things in-house. It's not a separate legal vehicle, and as the name suggests, it is the local authority delegating services, and that's to either a joint committee or a lead authority. Now we haven't got time today to tell you the ins and outs of all the different legal vehicles and the models, but this slide here is intended to give you a flavour of which legal vehicles apply to the different models. And as I say, it's critical that you get that right. We've had examples in the past where local authorities have said, we've had consultants in who've set our vehicle up, we're not quite sure what it is, what does it mean to us? And it actually means different accounting regulations, it means a different impact, for example, on tax, on procurement regulations. So you need to be really careful about the legal vehicle that you are setting up. Okay, so which model do you go for? It's really a matter of preference. There is no silver bullet that says do this model, do this vehicle, and it's a panacea for financial sustainability. It very much depends on your organisation, your culture, your demographics, the political leanings of that organisation. As I say, it's a very individual decision to be made. But the types of things that you need to ask is, do we really want to go down the route of having a separate legal entity and all of the additional costs that that involves? Do we want to do this on our own? Is it better to go into a partnership and share the risk and reward? Should we join one that's already in existence so we're not having to start from scratch? Do we actually want to be very commercial and have to deal with things like corporation tax, or do we just want to recover costs? And then also the critical question at the end, the level of local authority control that you require. And as I say, very often the political sovereignty is a major factor in deciding that particular issue. Now, to try and address some of that, we've got some frequently asked questions here and some of the answers as well. And these are the most common questions that we get. So people say to us, if I want to move to an alternative delivery vehicle, do I have the option to TUPE transfer my staff? The answer to that is yes. Generally, you can do that for every single model with the exception of local authority delegation. Now there, for example, the most common one is joint committees, where staff are retained within their respective organisations. Now, if you are TUPE transferring staff, you also need to think about the pensions issues, which is the second question. We're going to discuss pensions a little bit later on, but enough to say that if you are TUPE transferring staff, look at pensions. You will need actuarial valuations that might change pension contributions for the staff in terms of percentages. And then you also need to look at what happens to new staff when they come into that separate legal entity, which is the third question. Do they have admittance to the local government pension scheme? And what we're seeing very often is that for new employees to a separate legal entity, a different pension scheme is set up one that can achieve savings in the future for the council and the entity itself. Tax as well is a real sticking point. Do I need to pay corporation tax? Well, if you are trading commercially, then yes, you do, and that's now at a flat rate of 20%. If you are a TECL company, which is essentially a company that is providing services back to the local authority, then you don't pay that, because HMRC have declared that if you are providing services back to yourself, there is no profit, and if there is no profit, there is no tax. If, however, that TECL company is doing an element of trading, and it can do that up to a maximum of 20%, and that's based on its turnover, there is likely to be corporation tax payable on that. Charities, they don't pay corporation tax on what is known as their primary purpose trading. So again, you need to think very carefully about which model and which vehicle you want to go down. If you are a charity, then there are certain tax benefits, and one of those is charitable relief on your business rates. And we have seen within local authorities many leisure centres and leisure activities being set up under a charitable trust because the premises attract charitable rate relief. And that can make a huge difference to the profitability of the organisation. We're also asked about, can I trade outside the local authority? Well, absolutely. If you have a commercial trading company, that's absolutely fine. If you have a TECL company, as I've mentioned already, you can trade up to 20% of your turnover. If you trade more than that, and this is the TECL conundrum, that if you are very successful and you have a lot of external business, you lose your TECL exemption. Now, what that means is that under a TECL company, the local authority can give that company a contract without having to go through the EU procurement regulations. If you lose that TECL exemption, then the company has to go and bid for contracts in the same way as any other company. It's a little more complicated than that, but that's it in a nutshell. The next question we often get asked is about nervousness, particularly from members. They're saying, well, we're very risk averse, it's public money, we have stewardship duties, we want to do something, but what should we do? What a lot of local authorities have done is start with local authority delegation. So they've set up a joint committee between 2 or more local authorities to share services, and it enables them to do that in a relatively safe environment. And it develops a shared service working environment in terms of culture, in terms of trust, in terms of protocols. And once they can see that's working effectively, then that joint committee can develop into a TECL company or a trading company later on down the line in order to be more commercial and hopefully generate further income. We're also asked, well, what's the benefit of actually spinning out of local authority? If it's a smaller operating unit, surely that won't work. There's a lot of research out there that says smaller units mean people are closer to the customer, the actual unit is fit for purpose, it's reducing bureaucracy, and certainly in terms of staff mutuals, there's a lot of evidence. In fact, the University of Northampton have produced an excellent paper on that, which shows more motivated staff. It shows that it's much better in terms of operations, financially as well, and lower staff absenteeism. And then the last question, which I think we've already answered, is around going through EU tendering processes. If you have a commercial trading company, absolutely need to go through that processes. The only exemption to that is if you can set up a TECL company, and there are rules and regulations. It's not simply a matter of stating you have a TECL company. There are a number of tests, but if you comply with all those tests, then the local authority can provide contracts to that TECL company without them having to go out to tender. So a little summary of what we've just discussed. Which model? Again, there is no panacea here, no silver bullet. It's working out what's best for your organisation in terms of your economic outlooks, your political dimensions, your demographics, etc. You also need to look further than what you're doing at the moment. Look long term. So if you're setting up something, how is that going to evolve, and can it evolve easily? And always remember that although it's good practice to look at what everybody else has done, what's right for one authority might not be a success for you. And the last point on here is be very clear about what you're getting into. Look at the scope, look at the risks, and make sure you have an exit strategy, particularly when you've got partners involved. And do that right at the beginning. Address those concerns. Okay, the next, sorry, I've clicked too far there. The next real big question is, well, okay, we've decided what we want to do. We know the model, but what do we do with assets and liabilities, particularly in terms of setting up separate legal entities? Well, there are a whole host of business transfer issues, and I'm just picking up 2 or 3 of the most important ones here. And the first one is around property, or certainly long-term assets. The future use of those assets, who owns them, and any contractual arrangements, and for the accountants out there, the consequential accounting treatment in respect of those assets that the new separate legal entity will use needs to be addressed and appropriately resourced. And the arrangements, whatever they may be, will need to specify the responsibilities for general repairs and maintenance of the fabric and the structure of the premises. Now, our experience is that in order to minimise risk, in many trading companies, local authority assets are transferred to that trading company on a long-term lease, and that's included within the contract costs between the council and the trading company. If the local authority is leasing those assets themselves, then they do something such as a pass-through lease. The leasing option is partly because the new entity isn't likely to have the financial strength to purchase those assets, and also because it protects the council assets. If you passed all of your assets to the new company and that company becomes insolvent, then creditors could potentially seize what are very valuable assets. So leasing is a good option. What you do have to bear in mind, though, is if those assets are being used purely to provide a service back to the local authority, i.e. in a TECL company, then that might in accounting terms be classed as a service concession under something called IFRIC 12. Now, the local authority might not want to charge for those assets because essentially it's a circular transaction, and it could also trigger some unwelcome accounting implications such as sale and leaseback. The costs that the new entity will be expected to bear, such as rental charges, lease, insurance, should be included within the contract price with the council. Another area, which is in the staffing side of this circle on here, is pensions. And I said we'd come back to this. It's a very complex and very emotive issue. Now, any new company that's created will very likely take a share of the pension liability related to that workforce profile of those staff that have moved across. Now, the actuary and the organisation will need that, will calculate the new contribution rates, and they might be different from the previous ones. We've seen lots of examples when schools have converted to academies and hence become charitable companies limited by guarantee, that they found that rates increased significantly, and that became a major factor in deciding whether or not to move to charitable company status. Now, there are lots of decisions to be made over pensions, and the local authority will need to consider, will the transferring staff be fully funded, or will a deficit be transferred to the new company? Will the local authority guarantee the contributions and any outstanding deficit on behalf of the new company? Or will the new company need to obtain a separate bond? And certainly the pension fund will require either a guarantee or a bond. And then will the scheme operated by the company be open or closed to new employees? Now, all of those questions have political aspects as well as financial ones. In financial terms, the most cost-effective way of answering the questions is to minimise the extent to which the companies follow different policies in pensions and move away from the local authority. For example, contribution rates will be lower if the schemes remain open, but there is an additional cost if the companies have to obtain a bond, but none if the local authority acts as guarantors. Now, some authorities have sought to operate very much on an arm's length basis, and they've required the new company to take a deficit on the fund to obtain their own bond and allow them to decide whether the pension scheme remains open or not. Now, that has the advantage of transferring more risk to the company, and you could also say greater incentive to manage down the pension costs. But in accounting terms, you get into areas of the creation of goodwill, which may cause you problems. If the new company decides to close the LGPS to new employees, it can do that to make savings. So new employees have a different pension schemes, and we have seen examples where there are projections of making savings or cost avoidance into the millions of pounds. Now, of course, pensions are only an issue if staff TUPE across to the new entity. So if you have a lead authority or a joint committee, where in most cases staff are employed by their original local authorities, there's no TUPE, and therefore there are no pension issues. Another area to consider is the contracts area. And just to point out that if you are bringing external partners into, let's say, for example, a shared services arrangement, it's very important that the contracts amongst all the key players are watertight, and that the lead authority, or whatever the structure of the shared service is, has commercially based approaches which are robust. You need responsibility for the areas of service accountability and risk clearly defined within any arrangements and contracts, and again, the focus should be on service outcomes. That's a really important point there. So they're just a few of the business transfer issues. It's much more complex than that, and certainly usually requires some input from your legal departments around that. There are also a number of setup and daily operation costs to think about. One of the first ones is, who do I register with? Well, it depends what type of vehicle you set up. If you set up, let's say, a company limited by shares, then your regulator will be Companies House. If you set up one of the models that are applicable to a charity, then it's likely to be the Charities Commission. You also need to register with HMRC if you are trading because of corporation tax and also VAT issues. The new entity will also need a new bank account, and it also needs to consider who's going to provide it with all of its back office or corporate support services. I'm just going to explain this one in a little more detail, because you need a very clear understanding of what services are going to be provided to the new entity. You need to look at the nature of the agreement for buyback. How long does the entity have to buy back these services in full for? And that's because many councils have insisted on an incubation or transition period where the spin-out must buy back into the corporate services in full for X number of months or years. You also need to consider, is the price fixed or is it subject to review if costs change or there are efficiencies that mean costs are reduced. You need to look at whether there's a review period and what the process is, and also can the entity go out to market at any stage for any of their services, or is there a tie-in period? Now, it might be that elements of that service could be provided within the new entity through appropriately training your staff, and then the remainder could be sourced externally, either through the council or out in the market. Experience has actually shown us from a number of spin-outs that the cost of the services, although they are funded within the contract price, don't always represent value for money in comparison with market prices. And also the nature of what's provided by the council might not actually be suitable on what's needed for a separate legal entity that's operating in the commercial market. Other setup considerations are audit. If you are a company, you will have to do accounts that get sent to Companies House, and they will need to be externally audited. So what's the process for that? Who are you appointing as your auditors? You also need a scheme of delegation so that authority levels are clearly laid out. And then you also need to think about, well, what are we doing with our data storage and handling? This is and our IT system, particularly if you're not buying back into what the local authority is offering. And then things like, do you need to buy your own licenses because you're now not under the umbrella of the local authority? And also, what about insurance? All of those things have a cost, and it's essential that you include all of those costs. There are support service costs, as we've just talked about. You need to establish a credible baseline. Now, that's a really important point. You need to measure what it costs the current service and what you are projecting it will cost by delivering differently. If you don't do that, then how do you know it's more effective to move to a different delivery model? And it will also inform you of any break-even points. And without a break-even point, you cannot determine a robust pricing strategy and also assess the impact on any profit margins. You also need to look at VAT. Now, some services are exempt and separate legal entities may not easily be able to recover all of their VAT on those services. So social care is an example. There are ways around it, for example, by setting up a two-company structure, but it is more difficult and you need to be very aware of what you can and cannot recover in terms of VAT, whereas the local authority, they can recover everything. It's a very different position in terms of setting up a separate legal entity. Redundancy costs as well. You need to factor those in, particularly if you're looking at streamlining staffing structures, which is often the unpalatable part of the delivering differently agenda, but often a necessary one if you want to actually achieve cost efficiencies. Now, if you are setting up a separate legal entity, there are very specific costs, as you can see here. Corporation tax, we've already mentioned, so generally any profits made from external trading are chargeable to corporation tax. Now, it's important to know that that's chargeable before any dividends are distributed back to the local authority. Now, any profits that a trading company makes can be reinvested back into that company, but that's at the council's discretion, and that would be set out in your governance arrangements and your articles as well. If you are a commercial company, you will also need to think about the costs of bidding for work, any marketing that you need to do as well, and we've already mentioned charges from the council. You might also want to think about any borrowing costs and transaction costs as a separate legal entity. Obviously, the local authority has access to the Public Works Loan Board, which has very low rates of interest. We have seen models whereby the local authority has borrowed from the Public Works Loan Board, they've given a loan to the new entity, but then charged them a fee or a higher rate of interest for doing that. But it's certainly something that would need to be factored into any business plans. You also need to think about the big picture. If a council divests itself of a number of different departments and as a result the corporate core, i.e. finance, payroll, lose a large number of clients, what effect does it have on their costs? They will still likely have fixed overheads such as premises costs, they might have lease costs on IT servers, etc. That still needs to be paid. Now, there are two choices here. They either shrink if that's possible, or if not, they charge their costs out to a lower number of clients, meaning higher charges for those clients that remain within the council. Now, failure to give this area due consideration and diligence could potentially expose the council to additional costs if the new entity doesn't buy back those services in full, because the council will only save marginal costs. So it's a real issue to think about the big picture, not just siloed in thinking what's best for the council and what's best for the entity. The two will be linked, and you need to look at it holistically. So last but not least, let's look at the critical success factors. Now I'm going to take the two on the right hand side together, communication and stakeholders, and this is really around acceptance. There is sometimes a view, and we need to move away from the fact that monopolistic service provision is not the only option. We need education on the fact that other approaches, different delivery models, are likely to be needed and will be effective. We need to be very clear and communicate to all stakeholders the knowledge about what they can deliver and how they can de-risk those current approaches. But that involves dialogue with all your stakeholders. Now, many of the difficulties here, or the barriers in terms of people opposing this, are soft barriers, because it means changing the perspectives that people get very attached to. So you need to dispel the myths, you need to broadcast the benefits, and you need to reduce fear and anxiety that people will have. And of course, how do you do that? You do that through things like seminars, training, workshops, also transformation heroes, people that are there that can advocate the new change, and people can go to them and ask questions. Now, all of those different types of help make people feel that they are part of the solution rather than being done unto. Other critical success factors are firm foundations. Now, this is around your data. You need very credible data, so don't assume that what works in another authority will work in your authority. We've seen examples of shared services where the IT in one of the partners has been very poor in terms of it's old, it's out of date, it won't run the corporate IT system that you need to work that shared service effectively. You also need to look at the market trends. Again, we've had examples where people have set up trading companies and thought the market was out there, but when they've actually gone out to market, they found that nobody wants to buy their products, or there is too much competition, or their pricing strategy does not make them competitive. Another critical success factor is structure, and this is making sure you are fit for purpose. If you are setting up a shared service, for example, and you are simply adding two teams together, that's likely to increase costs and lead to poorer productivity. You need to structure in terms of streamlining both staffing and processes. And then you also need to have the resources to do that, and that's in terms of time, skills, and money. And that will likely involve buying in expertise, particularly in terms of legal information and perhaps also tax issues if you are setting up trading companies, and also if you have a lot of assets moving around. You also need to think about whether you are setting up group structures or standalone companies, because the tax implications of group structures could be very different from standalone. And last but not least, you need an effective agent of change, a hero, if you like, that can work horizontally and vertically across the authority, and they can promote change, but they can also affect it as well. They have the power to do things, and they will really organise the communication, they will make sure the data is there, they'll look at structures, and they will be one of your key resources to make sure that your critical success factors are all in place. So we're coming to the very end now, and we're just really summing up here about what you're able to do and what we've covered today. So we've explained the decision-making order. So that's about form always follows function. It's about looking at your strategy and your vision first. It's about moving to the model, and then it's about moving to the vehicle. It's also about understanding what different models and different vehicles mean and what you can and cannot do. So for example, if you decided absolutely do not want to TUPE transfer staff, you can look at different models. You might want to second staff, but you also might want to say, we'll move to a joint committee because we're not having to deal with staff and pension issues. If, however, pension issues are a major financial concern for you, then you might want to move to a company model whereby new employees have a different pension scheme which allows you to save money. You can also understand some of the high-level operation and setup requirements, and again, they're really important. We've been to some local authorities whereby the new entity didn't realise that it was a separate legal entity and thought it could journal costs back to the council. Of course, you can't. If you are a separate legal entity, it involves invoices. You also then need to look at the VAT situation around that. And last but not least, you can appreciate some of the critical success factors. If you want more information on this, and I'm very conscious that we have done 50 minutes here, a whistle-stop tour of what you need to know in terms of delivering differently, we have lots of information within CIPFA. We have some workshops coming up. Our procurement network in November is doing practical steps in setting up a trading company. The Finance Advisory Network in December is doing accounting for different delivery vehicles. And we've also got within our consultancy section, we have a number of people that are going out to local authorities and supporting them in looking at different delivery models. And if you would like to listen to more webinars from CIPFA, we have some coming up. We've got Making Sense of Governance in November, Leading Complex Change in November, and Accounting for Grants as well. And we've got the dates there. You just need to go onto the website and register for those. Now, if you have any further questions, and I've noticed that there's not been an awful lot of questions come up at the moment, you can email me. You've got my numbers on there. The slides will be available on the website, and any questions that we get after this, we will also put on the website if we think they are very general and it will help other people. So thank you all very much for listening. And as I say, any questions, please get in touch, and please check out the CIPFA websites. Particularly, can I point out our Transformation Hub, which will have a lot of information around all of these issues on there. So thank you very much, everybody.